Welcome to Market Domination. I'm Julie Hyman. Look who's back. Josh Lipton is back. Live from our New York City headquarters, we're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Making President Trump happy is always a good strategic move for a CEO of a company who's very much exposed to the types of policies that are going to come from this administration. I would focus less on the bombastic number. Again, this is a number that's made to make a political statement, but more on the fact that some of these investments may actually be incremental.
What has Nvidia done the past 2 years, David, that would suggest they're not going to come out here and beat big this week and raise up their estimates for the first quarter?
They've done nothing the last couple of years other than the foolishness. Well,
then why does everybody on the street own the stock?
The foolishness of an investment thesis that suggests that what has happened the last couple of years always repeats itself.
So we don't need AI chips from Nvidia.
Have learned the lesson against that the hard way.
So realistically, Intel is more of a value than Nvidia.
No, Intel is not. It's simply a story about valuation of a multiple. It's a story about order flow combined with valuation. There's two dynamics to what places a stock. It's both the fundamentals of the business combined with what you're paying for that story.
I would strongly advise against, over extrapolating these channel checks. Not to take anything away from this analyst, and I'm sure that the things he's hearing are what he's hearing, but I think these are the types of checks that can be very, confusing to take out of context.
We got 1 hour to go until the market close. Putting things in context for you, we're taking a look at the major averages, which are not doing a heck of a lot today. We've seen this trading in a pretty narrow range, but the Dow is performing better. It's up 164 points, about 0.4%. The S&P, very little change. The downside, down about 0.1%, but it's been sort of bouncing around today. The Nasdaq leading the losses, down 0.2%.
Now, we're muted today, but you got a potentially really key critical week here,
yes.
Right? I mean, we do have Nvidia earnings on deck, and yes, Nvidia has not done a whole lot of anything so far in 2025, but we know it is absolutely foundational to the AI trade and trend, AI economy. We got key inflation data on deck as well, so you're gearing up here for what could be a really important week.
Right, and coming off of a period of weakness for big cap tech in particular. I mean, last week, as we know, we had big selling to end the week. I don't know if you were watching from where you were away, watching the charts, but with the Nasdaq in particular having a weak period here. So falling again today, not seeing a bounce back, sort of an automatic bounce back from that loss is interesting to see. Now, as for Nvidia, as you say, let's take a quick look at how it is done this year. Well, today it's down about 2%. If you look at the year-to-date chart here, this here was actually a record high for Nvidia back on something like January 6th, I believe. It has not retaken that. It has made an attempt here, made a little bit of a weaker attempt there, but it's making what chartists like our own Jared Blucher would call lower highs, right? It is not retaking that. And so this is the setup that we are faced with going into the earnings. But guess what? Other large cap tech isn't doing a heck of a lot either. We were just hearing from an analyst talking about the report that Microsoft was perhaps pulling back on some of its AI infrastructure spending. The company says in a statement it's sort of maybe moving some things around, but not necessarily pulling back. But Meta shares down 2%, Amazon down 1%, Tesla down 1%.
Yeah, on Nvidia, by the way, we do have a very smart analyst who's going to come on the show, walk us through what to expect with that earnings print. I would point out to Apple, though, bucking that trend a bit in big tech, up about 1% today's trade. Of course, Apple made a lot of headlines today. Tim Cook's company saying, listen, we're going to spend and invest more than $500 billion in the U.S. for the next 4 years. We're going to hire 20,000 workers. We're going to produce AI servers here. And it kind of brings up just, I think, bigger questions, not just about the relationship between the Trump administration and Tim Cook's company, but just really overall this relationship between Trump and big tech.
Yes, most definitely, which we're also going to talk about later in the show. Quickly want to look at the sectors today. We've got tech doing the worst. We've got healthcare doing the best. But if you look at the year to date for the sectors here, we really have seen a shift here. Consumer discretionary, the worst. Tech only up 0.2%. So again, just emphasizing the Mag 7 is not leading the gains anymore. Communication services is up because of Meta, and then healthcare is the best performing group with RFK set to become HHS secretary. That's not necessarily what one would have expected year to date.
For sure. Well, let's get more on this now, because stocks are under pressure ahead of the closing bell as the markets brace for Nvidia earnings on Wednesday. And joining us now is Simeon Hyman, global investment strategist at ProShares. Simeon, it is always good to see you. Maybe just off what Julie was just talking about there, Simeon, something interesting you said, which is that investors seem to be now perhaps questioning whether there was a change in market leadership taking place here. What do you mean by that, Simeon?
Look, the good news is that tech stocks aren't falling through the floor. They're not leading, but they're not falling through the floor. So we're not in a position of suggesting that this is back to where we were in 1999. There's good stuff here. There's tremendous cash flow generation in the S&P 500, driven by that cash flow generation, has very low levels of debt. But things are changing at the top of the house, as you noted. Tech is almost at the bottom of the house in terms of performance so far year to date.
So how do we know if this is, sort of, sometimes we get this at the beginning of the year, right? You get sort of the scramble, scrambling up of the best performers from last year that then fall behind. How do we know if this is a sustained change in leadership? Do we just have to wait to find out, or what do you think?
I think you have to combine what the market's telling you with the fundamentals. And it's why, and look, it's tough to be the broken clock right twice a day. We always talk about dividends at ProShares, but dividend, and particularly growth and dividend growth, is on sale. And it's on sale in a way that it hasn't been in a long time. But even though the price has lagged, the fundamentals haven't. The S&P 500 Dividend Aristocrats, it's our ETF ticker, NOBL. You've got double the dividend yield. The dividends grow faster than the S&P 500, but the return on capital is 50% greater than the S&P 500. So I think you don't just want to shop in the bargain bin, you want to shop for quality on sale. And that's where you can get some sustained new leadership over the course of the next few quarters. I
have a separate question, Simeon, just as a long-time market watcher. I'm just curious to get your thoughts. When you hear that Warren Buffett, greatest value investor of all time, and you heard, Simeon, the kind of cash pile he's now sitting on, it's basically the market cap of Coca-Cola. When you hear the Oracle would rather sit on that than put that to work, what, as a long-time market watcher, what is that telling you as an investor?
It is tough to pay over 30 times for the companies that are having some of the greatest earnings growth. Q4 earnings were still very, very strong for technology, but it's tough to put that at work at 30 times. But there are opportunities. As an example, IBM is a S&P 500 Dividend Aristocrat. It's up 20% year to date, on the back of saying their AI business is good. So there may not be nothing wrong with the fundamental thesis. It just may be that those Mag 7 stocks got a little bit too expensive. And look, those of us who aren't great market timers, you can't sit on cash forever. We all know the numbers. You miss a couple of the biggest days and you're out forever. And by the way, if you're looking to manage risk, we would suggest don't stay out of stocks. Just make sure you have your balanced portfolio again, because we don't have zero yields on the 10-year Treasury. Look what's happening right now. The 10-year has rallied. So the ability for bonds to diversify stocks are back, and that's the prudent way for most people to manage risk, not staying in a money market fund.
Well, and you are the latest in a parade of folks lately who has said you need to be more diversified right now than you have been. It's not good enough to just buy the Mag 7 and forget it at this point. So what does that diversification look like? Do you buy, say, the S&P equal weight? Do you go down in size? Because small caps have not been doing much for you if that's the way that you have gone.
You can't stop at just adjusting your large cap portfolio in an equal weight sense. If you go back to the early aughts after the tech bubble burst, equal weight helped you, but you know what helped the most? Mid caps. Why use a blunt instrument of just equal weighting the S&P 500 when you can just have mid caps?
And everybody kind of forgets about mid caps.
It's the highest performing segment of equities over the last several decades. They're 50 cents on the dollar to large. And if you want a little extra opportunity there, the dividend growers and mid-caps are on sale even cheaper than the S&P 400 themselves. The S&P 400 Dividend Aristocrats, RETF ticker REGL, it's a very cool way to get mid-cap exposure.
Simeon, do you want to stay U.S. focused, or do you see any opportunities overseas? I guess it was today, for example, Chinese names. Some of them are really getting batted around, but some of those names have enjoyed nice recent runs, Simeon.
On the domestic front, there is an opportunity, particularly in mid-caps, to be a little bit sheltered from the tariff story. So mid-caps as a whole have 75% of their revenue sourced domestically, as opposed to about 50-50 in the S&P 500. And that makes a lot of sense to us, have a little bit of defense there. But I'm an investment policy statement guy. That means you don't zero out big parts of the market, and particularly developed international markets are still 20-25% of the equity land. So even if you want to be patient there, you still got to have 10 or 15% in your portfolio.
Simeon, good to see you. Thanks for coming in.
Thanks for having me.
We're just getting started here on Market Domination. Coming up, Nvidia earnings are indeed in focus this week. We're going to speak to an analyst on the other side to break down what to expect from the chip giant. Plus, Apple is betting big on the future of America, and President Trump, predictably, is loving it. We'll discuss the relationship between big tech and the United States government later in the hour. Stick around, much more Market Domination still to come. Nvidia is set to report fourth quarter earnings on Wednesday after the bell, and while the street expects it to deliver a solid beat on revenue and earnings, investors will be paying close attention when it comes to topics like supply and demand, forward guidance, the possibility of new tariffs, and the impact of China's DeepSeek. Joining us now, John Vinh, KeyBank Capital Markets Equity Research Analyst. John, a longtime Nvidia bull, I think it's safe to describe you as someone who has been reading your notes for a few years now on Nvidia. Let's take the DeepSeek part of this first. Let's just dive right into that, because you talk about that the demand for DeepSeek will cause demand for different types of chips from Nvidia. Why do you think, though, it won't hurt its main business?
So I think over the long term, I think the compute TAM, or the compute processing that's needed to train these, AI models, versus where we thought it was maybe a few months ago, that potentially TAM is going to be a little bit smaller, right? These optimizations that DeepSeek had introduced are likely going to be incorporated into some of these other AI models that Google and OpenAI are also developing. That for sure is likely going to happen. In the near term, DeepSeek is driving a surge in demand for these NVIDIA GPUs, these H20s that are China compliant by Chinese hyperscalers, because I think these hyperscalers recognize that it's possible for them to be able to train a lot of these AI models with lesser processing capabilities.
John, you just mentioned those hyperscalers. We just heard from them reporting their earnings results. Did you hear anything, John, from those big cloud giants that made you think they're spending as they build out AI infrastructure, as they spend on Jensen Huang's chips? Did you hear anything that signals or suggests, John, that spending is going to slow down in the near to intermediate term?
I don't see that happening anytime soon. The CapEx numbers have been really strong from all the major hyperscalers. I don't think anyone's kind of budging from, the CapEx intensity plans there. I think if you listen to kind of Sam Altman talk about it, he said, DeepSeek R1 is a very good model, but he kind of talked about it and saying, well, that addresses kind of a niche, maybe lower end segment of the market that's probably going to be used more widely within the China domestic market. But when you think about just globally, OpenAI and Google and Meta are going to develop AI models that are going to be much more comprehensive, addresses kind of high performance models, and they're going to require a significant amount of compute capabilities. So I don't see a let up at this point in time.
So John, when it comes to what we're going to hear from NVIDIA, both the numbers and the forecast, where do you think the suspense lies? Is it going to be more about whether they are able to make as many chips as the market would like?
I think, like every earnings, right? The call is going to focus on the results and the guidance. I think the results are going to be very strong. Nvidia has this cadence of just moderately guiding above consensus, and they're typically very conservative about that. But I think the focus on the call is really going to be around Jensen's commentary about DeepSeek, right? And I think he's going to come out and he's going to embrace DeepSeek, right? And he's going to say DeepSeek is great for AI. It's expansive to the overall TAM, and it's not going to be, it's not going to kind of cut down on the opportunity that's ahead of us. And if you think about it, Jensen met with President Trump at the end of January. Coming out of that meeting, there was not a ban on China AI chip exports as most people had feared. So it seems like, at least in the near to medium term, he's got the current administration on board with that sort of view.
John, I'm curious, what do your checks indicate right now about what supply and demand look like for Blackwell, their new chips?
I think supply is in a good position. I do think that there are some bottlenecks related to the ramp of NVIDIA's next generation Blackwell GB200 NVL platforms. These are the full server stack solutions that sell for $3.5 to $4 million. I think that's going through kind of a ramp up curve. There's some yield issues with that, but what we're hearing is that customers are able to pivot, and if they're not able to get these GB200 NVL server racks, they're able to pivot and order some of these more traditional server AI systems for Blackwell that are based on kind of the B200 chips. And then I think lastly, I do think that some of that yield and supply constraints is going to be backfilled by the strong demand and surge that we're seeing right now for these China compliant H20 chips as well.
John, what do you think the biggest risk is to NVIDIA right now?
I think the biggest risk to NVIDIA over the kind of the medium to longer term is whether how quickly these optimizations that DeepSeek has introduced make their ways into these kind of frontier AI models that are being developed by Meta, OpenAI, and Google, right? So if those optimizations get incorporated to these models, and that results in a significant reduction in the amount of compute intensity required to train these models, that could represent a source of risk to NVIDIA over the medium term.
Finally, we did want to ask you about Apple's new investment in, U.S. jobs and U.S. manufacturing, and just sort of the implications of this move and some of the other moves that we've been seeing to bring some of these operations to the U.S. As part of this, Apple's going to buy some more chips. It's already been planning to. Going to buy more chips from the TSMC plant in the United States. How are you thinking about the implications of all this for the chip industry in the U.S.?
I think it's great. I think there's a few things that are driving that, right? Apple seems like they're behind on the Apple Intelligence race. We also kind of do a lot of surveys on a monthly basis on iPhone demand, and right now from our surveys, Apple Intelligence is a complete non-factor in terms of driving demand for iPhone. And that's pretty disappointing, right? Because we've been bullish around the long-term opportunity around edge AI, but I don't see that driving any sort of demand right now. And I think Apple recognizes this. So they are obviously being forced and aggressively investing into their AI infrastructure, right? And I think the goal of that investment is to drive a differentiated AI strategy for them to develop compelling AI applications in these iPhones going forward, and to drive traction in Apple Intelligence.
John, always great to see you and to have you on the show. Thank you, sir.
Great, thank you.
Apple announcing it's investing $500 billion in the U.S. over the next 4 years, much to the delight of President Trump, who thanked the company and CEO Tim Cook this morning on Truth Social. The announcement coming as big tech continues navigating through Trump's ongoing trade wars. And for more, we're bringing in now Niki Christoff and company CEO. Niki, it is good to see you. So Apple certainly making big news today, Niki. $500 billion here in the US over the next 4 years, 20,000 workers producing AI servers here. One question I would have, Niki, as an Apple investor, I guess I'd want to know, did Tim Cook and company, did they do enough here to kind of satisfy Trump, make the president happy enough so that if there is need for it, Niki, Trump could now say, you know what, Apple, you've done enough. You have earned that special tariff carve-out, that tariff exemption. As remember, of course, Apple did, I believe, back in 2018. What do you think, Niki?
Well, that's exactly right. They did get an exemption from Chinese tariffs during the first Trump administration. Whether or not they did enough, I'm going to say probably not. What they did deliver, what Tim Cook delivered for Donald Trump, was a great headline: $500 billion in investment in the United States, 20,000 jobs. That's not nothing. But not only do we have to think about the Chinese tariffs, which he's promised, but also India tariffs. There are an awful lot of iPhones made in India, and we still don't know yet what those are going to look like. So I would be very surprised if this gets them 2 get out of jail free cards.
So what do you think would rise to that level, right? We've had a handful of these announcements thus far about investments in the U.S. Some of them are sort of repackaged of existing stuff that the companies are planning on doing. Some of it, you got a little new investment mixed in. What do you think would earn the carve out from Apple or from other companies who are trying to get it?
Okay, well, if I knew that, I might be on Apple's board, but I do have an idea of something that they could do. I think that what Donald Trump likes is to deliver on campaign promises. And he has promised to bring manufacturing jobs back to the US. He's been promising that for a decade. We have not seen a lot of success on that. They are talking about working with their existing suppliers in a lot of red states, including Arizona, Michigan, Texas, to start manufacturing there. If they can actually put people into manufacturing jobs, I think that is going to go a long way with the president. The second thing is if they can shift from nearshoring, there was a lot of talk about building things potentially in Mexico, and make it clear that they've changed from even considering that to moving fully to the United States. I think those are 2 more things they can do to get goodwill with the president.
I wonder, Niki, if Trump, he's hanging out there in Mar-a-Lago with another CEO, and he could say now, listen, Tim Cook, he just announced $500 billion he's going to spend and invest here in the U.S. over the next 4 years. I wonder, do you think it could be used by Trump as kind of leverage when he's talking to other execs?
Absolutely. This administration loves to line everybody up and make them agree to different things. We just saw Microsoft, as an investor in OpenAI and part of the Stargate Alliance, agree to a similarly sized investment in the United States. There's only so many companies that can go that far. But, Tim Cook and Apple are at the very front edge of this, of making commitments and giving good headlines. And the president wants to move fast on the things that he has promised. And that is America first, including having American companies make things here. So I am certain that that is a point of leverage with other conversations.
Niki, this Trump term feels very different from the last Trump term in a number of different ways. And one of them is that companies seem more willing to work with the president. Is that defensive? Is that offensive? What do you think is driving it? And what, are we seeing a disconnect? I mean, you talk to these companies. Are we seeing any kind of disconnect between these public-facing announcements and what they're saying behind closed doors?
This is a great question, and I don't think that you can lump all of the CEOs and the companies and executives together. You have people who appear to be more ideologically aligned with where President Trump and this administration is. I'd cite Mark Zuckerberg of Meta. And then you have people who are pure businessmen, right? Like the Jeff Bezoses of the world, who really doesn't need very much from this administration. And so you have a spectrum where I'm not sure their ideology matches with their business imperatives, but all of them have businesses to run. I think the difference, to your point, is that in the first administration, things were extremely chaotic. They moved much more herky-jerky throughout these first 100 days. That is not the case. They are moving at pace. They have an overwhelming majority in both Congress and in the election results. And so there appears to be a mandate. The president is moving fast, and they are jumping as required. And that is part of their jobs. How they feel ideologically, I'd say it's, people have described Tim Cook as 10% political and 90% business person, and I think that's right.
Do you think, Niki, Trump, he may talk tough, but do you think he would ever actually do anything to really go after big American tech, to jeopardize American tech in any meaningful way. Because if he did that, Niki, he of course knows he might, jeopardize the stock market. And this president watches the market very carefully. He uses the stock market as a kind of report card on the administration's success or failure.
Well, one definite boon to the technology industry with this administration is you have already the vice president going overseas to Europe and saying, you guys have been a drag on our companies. The prior administration was brutal when it came to competition with big tech. I think we still might see some of that, but at the end of the day, President Trump sees himself as a business person and he loves business success. So no, I don't think he's actually going to kneecap American tech companies, but he does want them to show up and show some deference and give him some good headlines, which again, Apple has done this week.
It sure did. Niki, great to see you as always. Thanks for joining us.
Nice to see you. Thank you.
Nvidia in focus ahead of the company's earnings later this week. Analysts expect double-digit growth for both adjusted earnings per share and revenue. Investors are waiting to hear from CEO Jensen Huang and what he says about the environment for AI chip demand and potential rising competition in the space from China's DeepSeek. Yahoo Finance hit the streets of New York to ask everyday investors about how they're deploying their cash and whether or not Nvidia is part of their portfolio.
I hold about 25 different stocks.
Currently, I like to invest in a lot of AI.
AI is the future.
With the rising AI.
I don't own Nvidia. I just haven't invested in specifically because I felt like I missed out on the wave.
No, I'm not invested in Nvidia. I haven't really followed the hype train too much on it.
To be honest, I don't keep too much track of Nvidia at this point.
I only owned Nvidia shares as part of like an ETF or a mutual fund. If it were 10 years ago and the price were a lot lower, I would have bought a lot of individual shares of Nvidia.
If I had the money, I would definitely invest in Nvidia.
I have some Nvidia, but I sold most of it. I thought that my money could be better spent somewhere else. If I had more money, I would buy more Nvidia.
I like Nvidia a lot. It did become one of my top stocks. I bought into it a long time ago, around COVID, and then I just got super lucky. I wouldn't buy any more Nvidia, so the price is a little too high for me.
I bought shares last year when they were, well, maybe not the best time because they were really high. I do follow the earnings report of Nvidia. I think it's definitely going to be positive.
Now time for some of today's trending tickers. First up, we got Palantir. That stock tumbling again Monday, extending its 4-day drop amid investor concerns surrounding potential Pentagon budget cuts and their impact on the data software company's revenue. The shares down more than 25% since last Wednesday. It first fell on reporting that Defense Secretary Pete Hegseth sent a memo to the Pentagon and military leaders looking to slash 8% from the defense budget every year over the next 5 years. Now, you and I have been watching this stock. Is it really down because of this, or is it down because it had run so far?
Yeah, it's a great question.
And people love to complain about the valuation of this company,
right.
which is high.
It's a headline, and you can tease out why some would get sort of nervous about it because, of course, Alex Karp's company does generate significant revenue from the U.S. government. To your point, though, Julie, and you read off the numbers, I mean, it's still up, even now, about 300% roughly over the past 12 months. So if you were an investor and you were looking for a reason to book some profit here, this would be one.
This might be your reason, most definitely. But it is trading at
look at that
more
chart.
than 170 times estimated
Remarkable.
earnings.
Yeah.
Is that even a real number? I don't know.
Right. Our next trending ticker, let's look at Alibaba. Now, those shares are sliding. That's after President Trump directed the Committee on Foreign Investment in the U.S. to limit Chinese spending on technology and other strategic U.S. sectors. So this one in the red. By the way, it's not just Baba. I mean, I was looking at other Chinese names in the red, too. We should mention these names have enjoyed very nice runs recently. I mean,
not
Alibaba.
Not Palantir-sized.
No, not Palantir.
But healthy.
Is it Palantir-esque? Someone said that recently.
Somebody did say Palantir.
I mean, Alibaba's, I'm looking here. It's up about 50% this year already. K-Web has had a nice jump, almost 20% so far in 2025. But that's the headline. That's why it's under some pressure today.
Yeah, and by the way, just separately, it's talking about spending on infrastructure.
$53 billion.
$53 billion. That's its plan. So it's kind of matching some of the U.S. hyperscaler commentary that we've gotten in spending plans. It's doing it, of course, in China.
All right, while earnings moving along, season is winding down to an end, and the focus we know has shifted almost entirely to Nvidia's results. There are still a few other companies reporting this week that investors should be on the watch for. Let's bring in now the one and only Kenny Polcari, Slatestone Wealth Chief Market Strategist and host, of course, of the Yahoo Finance podcast, Trader Talk. Kenny, always good to see you.
It's always a pleasure to be here.
So we mentioned there, obviously, yes, intention on Nvidia, big earnings print, but there are other names, right? Well-known names. What is Kenny Polcari's radar? What are you looking for?
So based on what we saw towards the end of last week with Walmart and the concern that created, they were cautious on their forecast. It created all kinds of nervousness in the market. Then you had Domino's Pizza today, which grew but didn't hit the estimates, but it wasn't negative, but it just didn't hit the estimates. And so originally they took out this morning, they were taking out 4.5% out of that stock just because I think it speaks to the consumer and the nervousness in the market. So then you have Home Depot and Lowe's that are coming out this week. Now that's going to speak to the consumer and housing and renovations and what are consumers doing. If they're not buying, are they renovating and that kind of thing. So that's going to speak to the health of the consumer. Clearly then there's the Nvidia, which is kind of a crowded trade, so everybody's focused on it. But I don't think Nvidia is going to be, I think Nvidia is going to be fine. I don't think they're going to be disappointing at all.
Well, I guess we'll see. But
so let me ask you, Kenny, if let's say Nvidia's fine, and you get a benign inflation print, the market reacts how?
So I think then the market rallies, right? If Nvidia's fine. Now, here's the problem with Nvidia. They're going to come out with a good number, and someone's going to find something that they didn't like, and they missed by a tiny bit, and they'll find a reason to take money out of it.
Their last two reports, they have not reacted great.
Correct. And so they could potentially do that again. Even if Jensen Huang comes out and wows them,
right.
They could still, you get the trader types that would hit the sell button because they'll just try to lock in some short-term profits. But look what happened. Right after it doesn't act great, they sell it off, but then they take it right up to new highs, right?
Right.
So while, look, I own Nvidia, we own Nvidia, I'm not selling the Nvidia no matter what happens. I don't suspect he's coming out with a disaster report. I do, though, suspect that he's going to have to address or somehow address the DeepSeek thing, right? However they're going to address it. But after that, I think Nvidia is fine, and I wouldn't, on a pullback, I would look to buy.
More broadly on the SPX, what levels am I watching here?
So I think you have to watch 5,800 on the S&P because look, we had the sell-off on Friday. This morning they tried to rally them, then they turned sour midday. Now they're trying again to kind of bring them back, but it just feels like we were kissing 6150, which was the high. We did it, 3, 4, 5 times, and we couldn't break through, which suggested to me just that the market felt a little bit tired, exhausted, and it needs to consolidate and pull back. So we broke through 6,000, 5,800 would be the level. 6,000 is the short-term trend line, but I suspect that's not going to really hold, and I wouldn't be surprised to see the market trade back to 5,800, which, by the way, I'm kind of hoping it does, because that's going to shake the branches a little bit, and as a long-term investor, it's going to create great opportunity.
All right, we'll see. Thanks, Kenny. Good to
Always
see you.
a pleasure.
Be sure to scan the QR code below. You can check out the Yahoo Finance podcast, Trader Talk. It's every Wednesday at noon Eastern. Kenny Polcari brings you expert advice, key market insights from the New York Stock Exchange. Here's a look at the latest episode.
I think you want to go where earnings growth is accelerating, okay? Right. So last year, earnings were the name of the game for the Mag 7, okay? Right. They had 33% earnings growth, which was double the market. They should get double the multiple. This year, earnings growth is decelerating from 33% last year for the Mag 7 down to 21%. The multiple has not contracted in line with that decelerating in earnings growth. The rest of the market had negative earnings growth the first 3 quarters of last year. It's now accelerating, and the multiple is half of the Mag 7.
So let's talk about that for a minute. So if the multiples in the Mag 7, it's decelerating. If earnings are decelerating,
earnings growth is decelerating.
But that's what your analysis tells you. That's just what is that what all the analysis
bottom-up consensus estimates. Yeah. So earnings growth is going to decelerate from 33% to 21%, and we're seeing it. It's a function of CapEx.
Right.
And people say that this is offensive. It's defensive.
Right.
It's defensive CapEx because you have no return on invested capital yet.
Yet. That's the key.
So for the next 2 years, they're going to spend a lot of money, and we're going to find out in 3 to 5 years if they're going to get a return on that.
Right, but they've made it very clear. Look at the last earnings season. They've all made it very clear that they're spending huge amounts of money building out AI and data centers and all that stuff, which I think is going to end up coming back. But it might take 3 to 5 years before they really realize the return on that investment.
Yeah, this was the first quarter since 2022 that you had 0% revenue surprises in the Mag 7.
Right.
So we all know what happened in 2022 with tech. It was a little bit softer than people expected.
Right.
Everyone was euphoric going into it. We also have the highest percentage of S&P components trading over 10 times sales since 2000. So there are a lot of multiples and a lot of metrics that point back to 2000. I don't think we're going to have anything like that at all.
Yeah, I don't
But I
either.
do think we're going to have a relative slowdown in terms of, those groups are going to have to consolidate their gains.
And that's actually okay.
It's very
to
healthy.
do that.
Very healthy.
You can't keep, trees don't go to the sky, right?
100%.
Tesla shares getting a vote of confidence from one of the stock's biggest bulls despite concerns over CEO Elon Musk's involvement in the Trump administration. Praz Subramanian is here with the details. Praz.
Yeah, Josh. Dan Eiswhite called the godfather of Tesla bulls.
Mm-hmm.
Anyone know it out here.
I like that.
Reiterating his outperforming $500 plus price target, talking about how, despite the challenges from Musk and his Doge initiative and sort of the low polling there and then the lawsuits and the Tesla protests, these kinds of things are contained as a brand problem. And there's three big sort of catalysts that he sees as the big way to move Tesla stock in the back half of the year. The first thing is, of course, that cheap EV. We've been hearing about that. It's supposed to come, potentially back half of this year, second half of this year. I've said that it'll be on the roads prior to July, is what he says, and it'll help grow global deliveries. Second, also the new Model Y is out. That's the refreshed Model Y, their most popular vehicle. He says that will unlock new demand for that vehicle because it's sort of kind of hit its sort of, the last, I guess you would say, the last sort of emissions there for that car because it's just sort of long in the tooth. And finally, paid unsupervised robotaxi testing coming in Austin in July. That's the big one. That's the big $1 trillion opportunity. It's autonomous driving, it's robotaxis, things like that. He thinks that's the big step. Plus, with Musk being in the Trump administration, going to ease some regulations there from that point of view.
You bring up an interesting point about the Model Y refresh because, you cover automakers. Most automakers refresh their cars every single year. And Tesla does refresh the software that goes into Teslas, but in terms of the actual look, the comfort, the bells and whistles inside the car, they don't really change that stuff, right?
Usually every 2 or 3 years you get a facelift, which it has not had since it came out in 2019, 2020. So it's been 4 or 5 years. So it is time for this kind of update. You're absolutely right. I wanted to say the car's running on fumes. That's what I wanted to say earlier.
There we go.
So anyway, yes, that is a big deal for them, is to get that car updated and to more new users' hands.
What did you make, Praz, of this Bloomberg report we saw today where they say that Tesla is running this software update for China customers? It sounded like basically driver assistance capabilities that would be like the full self-driving we got here.
Yeah, autopilot, FSD, things like that. Tesla had said that they were anticipating an early 2025, spring 2025 release of that software, but they're behind the ball here with other competitors that like BYD and others that already have that stuff, that kinds of capabilities in their cars right now. Tesla had some regulatory issues to deal with the Chinese government. Seems like they've gotten past that now, and they're ready to deploy that software per the Bloomberg report.
Praz, thanks a lot. Appreciate it. We're going to stick with cars now. Bank of America downgrading Rivian from neutral to underperform, citing risks piling up for the company despite making progress towards sustainably positive gross margins. Here to discuss, Bank of America senior automotive equity analyst John Murphy. John, thanks for being with us. So this downgrade following the company's most recent report here, what do you think was most significant that we learned that led then to your downgrade?
Well, great. Thanks for having me. There are a few factors. First, there was lower volume than we were expecting in 2025 in their outlook. So about 48,000 units, sort of at the midpoint of the guide, and that's where we're landing. Lower profits off the back of that. But I think the third thing, which is really important, is the commitment to gross margin positive or moderately positive, as they mentioned in their outlook, includes a fair amount, a couple $100 million of profit coming from VW as a sort of a capital infusion that's running through the revenue line and through the P&L that really, I think, obfuscates the quality of the earnings in 2025. So that was a real kind of sort of boogeyman, I think, in some of the details. In addition to that, it sounds like the R2 is going to be a little bit lower volume and a little bit later in the launch than we're expecting in 26. And I think there's some questions that are starting to emerge with this DOE loan, $6.6 billion that the Biden administration finalized at the last minute. And there's some risk that could potentially get canceled under the Trump administration and certainly under some of the actions of Doge right now.
What about that partnership, John, with Volkswagen? Because you also brought that up as possibly complicating earnings forecasts.
So the way the accounting there is working is a little bit different than you traditionally would in a JV. They're a minority partner, but they're consolidating the results. So that complicates the numbers quite a bit. But as I mentioned before, some of the capital inflow, about $2 billion, I think over the next 3 to 4 years, is coming in through the P&L, which is a little bit of an untraditional way for counting capital infusion. Usually that's coming through the cash flow statement in the financing section, not through the P&L.
John, I'm curious what would change your mind here on Rivian, right? Well, I mean, I know you just downgraded the thing, but, do we need to see more of a turnaround, a wholesale turnaround in the EV market in the U.S. that could potentially benefit a company like Rivian?
So I think RJ and the team are doing a really good job on the product side. R1 really is an amazing product. If you've driven it, we've test driven it many times, it really is a really fantastic product, but it's an expensive one. So what we're looking at is a gap in product introductions until we get into 2026 with the R2, which is about a $45,000 plus or minus vehicle when it's launched. And that's where the market starts to open. Think about that as kind of their Model Y moment where Tesla really took off and volumes really started skyrocketing. So I think what we're going to need to do is fight through this next year and a half or so, maybe even more, till we get to that sort of more mass market product and things could really start clicking for the company. Really good product, great founder, really smart guy, understands what's going on. But execution so far on model launches has been so-so, and we really need to get to that higher volume product.
John, I'm just looking at the stock. It's up about 12% over the last 12 months. How does valuation look to you, John? Obviously, you don't think it's too attractive here.
Yeah, well, I mean, the beauty is in the art of the beholder here, because you're looking at something that's going to have a payoff pitch 4 or 5 years down the line when they turn free cash flow positive. So, we're looking at EV to sales right now to kind of benchmark companies that are in these early stages of ramping up. We're using 2 times EV to sales to get to our $10 price objective. In reality, you always want to look at a DCF, but without a lot of cash flow in the next few years, there's a lot of risk and uncertainty in looking at a DCF. So for us, I mean, we're looking at a $10, fair value at the moment. And we're going to have to see how the next few months or next few quarters, I should say, really develop over time.
And John, finally, I do want to ask you about Tesla. We were just talking about another analyst call on the company, an analyst who has been a bull, who is still a bull. There's been a lot of noise, obviously, around Tesla lately, but it's not just noise. The sales have been falling. We've seen some protests kind of bubble up around the country. Is that going to continue to pressure the sales, do you think?
Well, I think there's a lot of things fundamentally that are pressuring the company at the moment. Clearly, it's a first mover. They have great tech. They have a founder that's committed to the business. Love him or hate him, he really is driving that business hard. So I think there are a lot of things to like here. But I think as I heard in the prelude, the product is long in the tooth. And the Juniper or the Model Y Juniper is a mid-cycle major. We do a lot of study on product pipeline and our car wars analysis that we put out once a year and actually update periodically. They are really behind the ball on product intros. And kind of like I was just saying about Rivian, they really need to get on their horse and get a lot of new products launched. They're going to launch, supposedly, a low-cost product by the middle of this year, a second product off of that. That'll be sort of 3 and Y, lower-cost derivatives. And we have to watch their product cadence over time because no matter whether you believe this is a tech company or an auto company, product cycles always matter. They matter for the iPhone, they matter for cars, they matter for any other consumer good. And that's something they really have been behind on. So I think that is a real risk. And then you could sort of get into the questions on Elon's political involvement around the world and what kind of impact that's going to have on sales. The reality is that seems like a bit of a risk, to be honest, but something that is sort of secondary to sort of the core company being a little bit behind in product introductions.
More generally, John, just as an analyst who thinks a lot about this space, when you look at EV demand, over the next 6 months, 12 months, broadly, John, what does it look like?
Well, we have one major question mark. It's the IRA EV incentive, $7,500 for the consumer, whether that persists or does not persist under the Trump administration. If that gets canceled, I think here in the U.S., we're probably going to be stuck at a penetration rate that's right around 8%, where we were last year, and it may actually even fall from there. If the $7,500 sticks around, I think we'll see a drift higher, but clearly the consumer is pushing back. Most EVs are higher priced. For most folks, they're difficult to use because they don't have a charging station at home. So there is going to be some real challenges sort of from a fundamental standpoint. And if that IRA incentive gets canceled, potentially in the reconciliation process for the budget that the current administration is trying to push through Congress, there's some real risk that we get stuck at around 8%, give or take, in the U.S. for years to come.
John, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you.
While we are wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.